2020 is half over, and it's been quite a year. Yet if one fell asleep on New Year's Day and just woke up and looked at the US equity indexes, one might think little had happened. The S&P 500 was 3230 at the end of 2019, and it closed the first half of 2020 at 3100, down a mere 4%. While the tech-heavy NASDAQ was up double digits and the small company Russell 2000 was down double digits, it was a mixed market. Of course, the first half was anything but boring. We thought we would take the evolving narratives as the best framework to appreciate just how volatile 2020 was in the first half. The year started on a relatively calm note. During late January and through February, as the COVID-19 virus spread through China, the narrative focused only on China. U.S. equity indexes hardly reacted. That changed dramatically in late February, when the market narrative shifted gears to fears of a global pandemic. From February 24 through March 23, U.S. equities dropped precipitously between 25 and 50%, depending on the index, with the Russell 2000 falling the hardest. In March, the U.S. federal government and the Federal Reserve both announced massive stimulus programs, and late in the month, all the equity indexes turned abruptly upward. By April and May, the talk was becoming even more optimistic, with signs that economies would soon be able to reopen in phases. A few analysts even started discussing the possibility of a V-shaped economic recovery to match the V-shaped equity recovery. The second part of June, unfortunately, brought a much more cautious note as COVID-19 started to surge in places where it had previously not been very active. The market narrative began to appreciate that the economic rebuilding was going to take considerable time and that a V-shaped recovery was probably off the table. Indeed, it is critical not to confuse a highly likely quick bounce back that may not be sustained with a V-shaped recovery to previous peak levels of unemployment and GDP. What will matter in the second half of 2020 and into 2021 is the pace of rebuilding. Even as many of the companies hurt by the pandemic downsize to meet more sluggish demand from consumers trying to save more and repair their balance sheets, neither consumers nor corporations are ready to resume activities as if the pandemic had never happened. Travel, tourism, restaurants, etc., all are facing very sluggish recoveries. Investment projects are being shelved and delayed. It is clear that the overall jobs picture is actually very murky as to the speed of the recovery. The second half introduces heightened political risk and a return of global trade tensions, not to mention the ever-evolving pandemic story. Finally, we note that elevated volatility comes with dynamic movements in the way equity indexes are correlated to each other. Most interesting is the shift in correlations when markets are declining compared to what happens when markets rise. When market participants are dealing with falling prices, we tend to see correlations at their highest levels, approaching 0.99 or almost perfect correlation. When markets are rising, correlations among the indexes start to show a little divergence. Tech stocks in the NASDAQ, for example, dance to a different drummer than the small company stocks in the Russell 2000. Among individual stocks, the lower correlations are much more striking than for the indexes. All of this suggests that the second half may see market rotations around different indexes, as well as sectors and even stocks, as the volatility remains elevated. I'm Blue Putnam, Chief Economist, CME Group.